Today we're diving into something really important for commercial property owners in Australia, claiming your motor vehicle expenses at tax time. In this video, you'll learn exactly how to legally claim motor vehicle costs related to your commercial property management, potentially saving you thousands at tax time. Everything you need to know is coming up. We'll cover who's eligible for these deductions, the crucial difference between commercial and residential property rules, the two main ATO-approved calculation methods, documentation requirements, and special considerations for commercial vehicles. Now, this is actually a great tax break that a lot of commercial property investors don't fully take advantage of. First things first, if you own commercial rental properties, you absolutely can claim tax deductions for travel expenses related to managing and maintaining those properties. This includes all those kilometres doing property inspections, handling maintenance issues, collecting rent, or even meeting with potential tenants and agents. But here's something really important to note. This deduction is only available for commercial rental properties. If you own residential rental properties, unfortunately, you're out of luck. The government changed the rules back in July 2017, and residential property owners can no longer claim these travel expenses. So this is specifically a commercial property owner benefit. We have two main methods to calculate and substantiate your motor vehicle expenses. The first is the cents per kilometre method. This one's pretty straightforward. You can use this method for cars that are designed to carry less than 1 tonne and fewer than 9 passengers, so your standard car, basically. With this method, you simply multiply your rental-related kilometres by the set rate. For the 2024-25 income year, that rate is 88 cents per kilometre. So if you drove 1,000 kilometres for your commercial property management, that's an $880 deduction. Let me give you a practical example. Say you own a commercial property with retail tenants in Brisbane. Every month you drive a 40-kilometre round trip for routine inspections, another 30 kilometres to meet with contractors for maintenance, and occasionally 66 kilometres for tenant meetings. Let's say that's 1,500 kilometres for the year, which equals a $1,320 deduction using the cents per kilometre method. There is a catch though. You can only claim up to 5,000 rental and work-related kilometres per car per year using this method. If you're doing more than that, you might want to look at the other option. The nice thing about the cents per kilometre method is you don't need to keep a full logbook, but you do need to be able to show how you came up with your total kilometres claimed. So keep a diary record of the odometer readings when you visit properties. The second method is the logbook method, and this is better if you use your vehicle for both rental property visits and personal use, and a large portion of your travel is for the rentals. For this one, you need to keep a logbook for at least 12 consecutive weeks, and in that logbook, you need to record the date of each journey, your odometer readings at the start and end, the total kilometres travelled, and crucially, the purpose of the journey. You must use a 12-week period that is representative of your usual travel pattern. Once you have that 12-week sample, you should calculate the percentage of your driving that related to the rental properties. Then you can apply that percentage to all your vehicle expenses. We're talking fuel, maintenance, registration, insurance, and even depreciation and interest. So it can end up being a much bigger deduction if you do a lot of property-related driving. For instance, if your logbook shows that 62% of your driving is for commercial property management and your annual car expenses total $10,000, you can claim $6,200 as a tax deduction. That's significantly more than the cents per kilometre method would allow in many cases. The good news is that once you've kept a logbook for that 12-week period, it's valid for 5 years. You only need to do a new one if your driving patterns change significantly. Check with your accountant for the rules around change patterns of use. Now, what about if you have a commercial vehicle like a ute or a van? If your vehicle isn't classified as a car, like if it's designed to carry loads of 1 tonne or more than 9 passengers, then you'll typically use the logbook method for your rental claims, but you'll need to keep all your receipts for expenses and maintain that logbook to work out your rental use percentage. The bottom line here is that proper record keeping is absolutely essential. So if you own commercial property, don't leave money on the table. Track those kilometres, keep those receipts, and make sure you're claiming everything you're entitled to at tax time. Managing commercial property can require a lot of travel, and these deductions can significantly reduce your overall tax burden when done correctly. Make sure that you check with your accountant to be sure that you meet all of the requirements, and download our free rental property guide. The link is in the description.